What's up everyone, it's Caddy with Money Investing. In this video, we are going to be talking about market breadth, and I will be going over the NASDAQ more specifically because the market is lacking breadth. And I wanted to go over, where is the money really going to right now? The liquidity, and again, talk a little bit about the outperformance because NASDAQ in the first quarter of 2023, by the way, the first quarter is just coming to an end at the end of March. Q1 is going to be over. NASDAQ is going to see the biggest outperformance, of course, if the gains actually hold up till the end of this week here. NASDAQ is going to see the biggest outperformance relative to the S&P 500 since the first quarter of 2009. We're actually going back quite a few years here to pretty much see the NASDAQ's outperformance relative to the S&P 500. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us, we'd love to have you on board. We've got a little bit over 3,700 members, and there is a 16% annual discount available for everyone to join and take advantage of before the end of this month. So again, that's an annual discount. You'll get access to all the alerts, all the signals, everything that's included, along with the private videos and tutorials and lectures as well. So all benefits linked down below. So first things first, we are going to be talking about is the outperformance itself. So if you take a look at, how QQQ has performed relative to SPY, it's up over 6%. QQQ, however, on the month is up a little bit over 5.9%. But if you take a look at where we were back in January, so at the beginning of January, we were at 260s, and it has rallied a little bit over 20% in the first quarter. Very, very substantial amount of outperformance here with respect to where the SPY is. SPY January 3rd to where it is right now, only up 5.7%. So in the last 3 months, the QQQ has outperformed the SPY by 4 times. We have seen a lot of outperformance for this particular indicator or index. And from its January 3rd low, it is up a little bit over 14.5, almost 15%. So that's the level of outperformance we're seeing for this particular index. Now, I want to go over some specific charts, which I think is going to be very, very helpful, but this is where we are at. This is as of the close, I think, last week, March 25th, and that was the outperformance of 13.3%. Again, the biggest outperformance going back to as far as 2009. This is the big candle you see. That's how it's comparable to. That's how much outperformance we're seeing in the NASDAQ. Now, another really good metric for us to focus on because, we've already talked about where the liquidity is going, right? I mean, the reason why there is the banking crisis, of course, Silicon Valley Bank failing, then Signature Bank, and we got First Republic, we got Credit Suisse, we got a lot of bank failures. I've already mentioned why I believe that investors right now are taking refuge in 2 places, right? We got the yields and we got big tech. Of course, there's been gold as a potential hedge and semi-stocks as well. Semiconductors I'm going to club into technology, but it's mostly been big tech, right? Big tech is what is driving this outperformance. And that's what is a little bit concerning, right? That's what worries me a little bit because I've got some charts and some data to show you. But first things first, let's just talk about how much these stocks have performed in the last 3 months. In the first quarter of 23, Meta is up 72%. If you take a look at Apple, how much Apple is up in the last 3 months since the beginning of January. So if you come over 3 months here, it's up over 20%, right? Very much in line with the NASDAQ. If you take a look at how much Microsoft is up, another super high big tech stock, in the last 3 months, Microsoft is up a little bit over, I'm just going to wait for a little bit, 16.8%. Google may not be up that much. Google is still struggling at the moment. I think Google and Amazon might not be that high. But since the beginning of this year, it's up 17.5%. Google is still up from the beginning of this year. Amazon here, since the beginning of this year, very quick analysis. So it's up over 5% is what it shows. So again, Amazon's been pretty much sideways. It's actually up 15%. It was up to, at one point, up 32%. But right now, it is up a little bit over 15% in the first 3 months. Again, 14.8% to be precise on a year-to-date basis. And if there's any stock that I'm missing, of course, NVIDIA, not to mention, is going to be up over 75, 80, 90%. So you've got NVIDIA in the last 3 months since the beginning of this year. It is up 75%. Year-to-date, it's up over 80%. Now, the reason why I bring this up is because there's few charts that I found really interesting on Twitter. And that is that the new highs that are the stocks making new highs within the NASDAQ has been falling since February. Right? Since February, it has been on this consistent decline in terms of percentage of stocks that are actually making new highs. And when you look at, some of the other indicators, this is another really cool chart that I was able to find, and it pretty much shows you the NASDAQ number of stocks, new 52-week highs versus new 52-week lows. And look at that difference. Look at that insane difference between the percentage of stocks that are actually moving up versus percentage of stocks that are actually moving down. 35 making new 52-week highs. This is as of last week, by the way. So this is not the most up-to-date, most current numbers, but this is as of last week and I think last couple of weeks, and 35 on this particular day, and 340 stocks were making new 52-week lows. And what this spreadsheet shows you is the net, right? On a net basis, are we making new 52-week highs or are we making new 52-week lows? And every single number in the last 8 days or 9 days is negative. What does that mean? That means there's more stocks making new 52-week lows than there is stocks making new 52-week highs. And they haven't even crossed over 70, 80 levels. I mean, most of the time, we've only got a handful, 36, 31, 31, 28, 35. And the number of stocks making new 52-week lows are in the hundreds, right? So we got 193, 147, 214, 432, 600, 547. So, that just goes to show how there is, on a net basis, we've got fewer and fewer stocks actually making new 52-week highs. And again, if you kind of compare that to the concentration in big tech, these are some of the weights for S&P 500, and these are some of the weights for the NASDAQ 100. Microsoft over 12.6%, Apple 12.3%, that's 24, 29, I'll call it 25%. Amazon 6%, that's 31. Nvidia another 5, that's 36. Google is 3.8, call it 4%, just rounding up. So we're now at 40%, and Tesla 43.6, and we got 46, 47. So almost half of the NASDAQ 100 is made up of these 8 companies, or these 7 companies, because we've got Alphabet in there twice. So these 7 companies that pretty much make up 47% of the NASDAQ 100. If you compare that to the S&P 500, though, we've got, I think, closer to 20 to 22% for the top 8 companies, including Berkshire Hathaway and then Tesla and Meta Platforms, of course. But the point that I'm trying to make is that we certainly have a little bit of divergence forming between the market itself and the breadth behind it. And this right here is another really, really cool chart, which pretty much goes over the percentage of stocks that are trading above their 200-day moving average with respect to the S&P 500 itself, or I think it's the NASDAQ. Let's see, it's the NASDAQ, right? So I've got the NASDAQ in orange, so you can see the NASDAQ in orange, and you've got the percentage of stocks trading above their 200-day moving average in the actual candlesticks. Now, think about that for a second. I'm actually going to compare this chart with the NASDAQ as well. But if you think about it logically, right, what does this chart tell us? This basically tells us what percentage of stocks are trading above their 200-day moving average. So if that number is high, right, or if that number is increasing, you'd expect the markets to be pushing higher, right? It's logical, right? It makes sense, because if there's more stocks trading above their 200-day moving average, if there's more stocks moving above their 200-day moving average, the markets should be moving up. Now, the opposite is also true. If there's more stocks trading below their 200-day moving average, or if there's more stocks now trading down even lower, and they're continuing to trade lower below their 200-day moving average, the market should be coming down. The market should be lower because the breadth is weakening. And that's played out perfectly well, as you can see very much in a lot of instances when both of these go down together, right? You see they're both kind of like moving in the same direction over here. So as more and more stocks are trading below their 200-day moving average, the NASDAQ is selling off. Same thing happens over here. You can see they're overlapping, right? They're overlapping over each other. And over here, you can see a very nice rally. You see more and more stocks trading back above their 200-day moving average, and you're seeing the NASDAQ also move up. And again, you can see that once again over here, right? Both of them moving down together. Now, what I want to show you is what's happened more recently, right? So if you actually compare the two charts now and what's actually taking place, you still have some similarities, right? Very much similarities. So you can see a little bit of a drop here. You see the drop over here, right? Then you see a very strong rally, and percentage of stocks trading back above their 200-day moving average is increasing. You've got a very strong rally in the NASDAQ as well. Well, look what's happening now, right? We have this indicator pretty much falling, right? And the markets in the last, since the beginning of March, I would say, like the middle of March, March 10th, it's been pushing higher, right? As this indicator is not really going anywhere. It's actually been coming down. Now, if I compare this to, let's say, the NASDAQ 100, so what I'm going to do is I'm actually going to come down to, what is it, this chart, I think, percentage of NASDAQ stocks. I just want to find it very quickly. I think it's this one, or it might be this NCTH. There we go. So NASDAQ composite stocks trading above their 200-day moving average. And if you compare that to where the market is, you can see once again that we're seeing a little bit of a divergence play out, because this chart over here, again, it's been working together really well, pushing higher because the breadth is really strong. It started to come down over here, but then something changed. It started to flip right back over. It's now starting to push back up, as this one is now starting to trade more sideways, if anything lower. So that's the divergence that I wanted to point out. And in the past, like if you notice that every time we have seen this divergence, so let's just go back and try to spot some more divergences between these two charts. So you can see again, they're very much correlated. But a few times that I was able to find this divergence play out, I'm actually going to remove everything just so it becomes a more clean. So what you'll notice is that this is the NASDAQ, right, in orange. And over here was that divergence, because you had, for this longest period, more and more stocks trade lower and lower below their 200-day moving average in the NASDAQ, and yet the markets kept on pushing higher. And we know where the biggest outperformers were during that time. It was big tech, right? Big tech was the best performing sector. I mean, Tesla, Google, Meta, Microsoft, Amazon, Apple, they were all the ones, Nvidia, AMD, they were the ones that were really driving the markets to newer and newer heights as the breadth was weakening. In other words, you're not really seeing a broad-based rally. You're seeing a very concentrated rally because of the investors taking refuge or hiding out in these names. And what happened eventually, of course, it was once again, as big tech started selling off, right? As big tech was the one started to pull back, we had that intersection over here where both of them started working together once again. And of course, we're seeing that overlap happen. But this was a big negative divergence, right? You can see that this chart itself was coming down. Not many stocks were trading above their 200-day moving average. We in fact went from 94% down to 51%. So half of the stocks were selling off, and yet the NASDAQ kept on pushing higher, plugging away to new all-time highs until finally it started to break, as big tech started to break, and we're starting to slow down. So that is that divergence. I want to keep kind of emphasize on that. And it's possible that, the markets keep on pushing higher on the back of big tech, but we need a much broader based rally in order for this to be more sustainable. Because if it's not a broad-based rally, if there's no breadth behind this move, then eventually, the gas is going to run out. I mean, you can only take Nvidia, Tesla, Apple, Amazon, these big tech companies only so far up that at some point they're also going to start to become a little bit more on the overvalued side. And you will find, as a pullback happens on those stocks, the NASDAQ will also pull back. So something definitely to consider moving forward. So hope you guys enjoyed this video. Just wanted to present some of the analysis here. And again, this is another chart that pretty much goes over the NASDAQ 100 advancers. This does suggest that last time we did have a lot of advancers, meaning stocks are still pushing higher, but they're not making 52-week highs. The NASDAQ did rally further. So it is possible that, we continue to see this momentum play out. We continue to see a lot of, short-term upwards biased on the NASDAQ. But if it continues to stay more concentrated, that's going to be a bit of a problem. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like, subscribe to the channel. As always, happy investing. I'll see you all in the next video.